Now, again, we are seeing a comeback for both VC and private equity. So the crisis has affected private equity and VC investors in different ways. Private equity investors have become very cautious and have suspended deal activity for a few months. But as I predicted back in June when I wrote an article for a legal publication, their activity is now coming back. VC investors have also slowed down their deal-making activity, but I think we've seen that they have continued and they have signed and closed transactions even through the lockdown period and so on in the summer months. And then now, again, we are seeing a comeback for both VC and private equity. I think VC is coming back stronger, but private equity also is showing some signs for heating up their engines again. The only difference is that I guess during this period, private equity investors will probably focus primarily on finding bargains as opposed to growth, which is also a focus for private equity, but maybe less than it is for venture capital, where the word bargain doesn't exist. So again, I think the crisis has slowed down activity, private equity more than VC. We are seeing comeback, and the comeback will continue because it's fueled by a lot of dry powder, so availability of funds for both types of investors to invest. Startup founders thinking about an exit need to be realistic. This is the first point that I would make when talking to someone who thinks about an exit. Realistic means to have a correct assessment of the status of the development of their company and whether or not they're ready to exit, or maybe further development of the business is required. At the same time, realistic means to have a good view and realistic view about the valuation at which an exit can be performed. The second point that I would make is that a startup founder needs to generate interest so that when you perform an exit, you have more than one option. You have to have at least two interested parties in order to really get a good deal. If you are very early on negotiating on an exclusive basis with one investor, it may be that the valuation you are getting is lower than, or the terms that you are getting are worse than you could expect. And the third point that I would make is that a startup founder needs to get the best advisors he or she can afford, and to let such advisors guide the founders through the exit. This is a process which is much more familiar to investment professionals and lawyers than it is to a startup founder who is probably doing it for the first time. M&A in Romania encompasses a lot of things. When we're talking about startups, most often we think about venture capital financings. And as I was saying earlier, venture capital investors are very active and they are willing to deploy capital. Of course, you have to have an interesting project. A lot of the pitches are turned down by VC investors, but this is nothing new. When we talk about more traditional M&A, we probably come back to the earlier question about exits. And the discussion is whether or not there are opportunities to exit at this time. And I would say that this depends on whether the company is mature enough for an exit, which means that it generates positive EBITDA and or a positive cash flow, and this positive cash flow has a trend of growing. This is when I think there will be interest from private equity or strategic investors to invest. As opposed to 2020, when we have this big shock, but the shock was somehow cushioned by the measures that all the states took to protect the economy. 2021, I expect a little bit of a more mixed picture, in the sense that we will probably have a lot of interesting transactions for successful companies who will command high valuations. But at the same time, we will see a fair level of distressed M&A. So mergers and acquisitions for companies who are not doing so well and require some rescuing, essentially. So I think the level of activity will be high in 2021 as well. But for startups, frankly, I think it will be a good environment to raise capital if they have a good project. It could be a good environment to exit if they have a positive cash flow. Otherwise, probably not so good. Big companies, so strategic investors that would be looking at a startup, normally value one thing very much, which is market share. Even though the market share may not be huge, the fact that it's growing very fast, that may attract the attention of the strategic investors who may see a startup as an existential threat, and therefore they would be willing to enter very early on into negotiations and try to buy up that company, that startup. If that is not on the offer, let's say, from the startup, that the startup has not yet reached a significant market share, will not bring necessarily this kind of value to a strategic investor. What is also important, but perhaps a little bit less valuable, is an innovative technology that a strategic investor has an idea how they could leverage. And finally, if that is not really innovative and the technology is not such that it will really kind of attract the attention of the innovation department in a big strategic company, sometimes the team can be an interesting asset to sell. But if you get to that level, that discussion, I think that is where the valuation is lowest from the three types of activity or the three types of transactions that I've described. Legal is closely intertwined with business issues. So what I will be mentioning is not necessarily just purely legal issues, but things that have to do with both legal and the business. I think the first thing that startups should be wary of is whether the the IP is in good shape, whether it's tidy, everything is really well connected and documented. Because a lot of the time, founders have the assumption that just because they have been working on the project for several months, the IP belongs to the company they founded. And a lot of the time, because there are no contracts, no documents to evidence this, this can be an issue. So it needs to be cleaned up relatively fast by putting in place proper legal documentation. Another thing which is quite relevant is the capital structure of a startup. Sometimes founders are very generous with the shares in the company, and they offer maybe employees who are not so key, or some people who had a contribution at the beginning, but not necessarily intend to stick around in the business for a long time. They offer generous packages of shares, And you can end up with the founders owning too little, and then when a venture capital investor would come in, they point out this issue that they don't want to dilute the founders to the level where the founders are not really motivated anymore to continue in the business. So you have to be a little bit stingy and a bit cautious with the share awards that you do. And finally, I think another important point is to focus on the business and not precipitate too much an international expansion and the relocation of the headquarters out of Romania to the US or Western Europe. While this is a good idea and you will probably have to do it at some point if the company grows and it starts to sell massively in the US or in Western Europe, doing it too early can basically shift the focus from the business to structure and legal issues at the time when this is not the key priority.